Well, welcome everybody. What a big room we got coming in here. This is awesome. Just to let you know, I've been doing this for quite a while now with our tools members. Welcome back, Optionetics students. We're bringing you into the fold this week for another Tom's Trading Essentials Week. All right, presented by Optionetics and Tom's Trading Room. Glad to have you guys here. This is one of my better looks because now we're all having to do things that we haven't done before. At least some of us have. Like for me, it's been fixing the air conditioner, the air handler one week, and then one week it was what did I do? I had to fix the washing machine. I actually had to change the belt on a washing machine. Never did that before. Got that done. It took 3 times. 3 times a charm, but I finally got it. I finally got it on there. I had 3 belts I ordered before I got it right and realized that there was more than the belt that needed changing. Anyway, glad to have you guys here. Obviously, unprecedented times. The last time that we all got together, we were near the top of the range on the way down, and what a difference 6 weeks makes. So like I said, I'm very excited to have you guys all here. This is going to be a 4-day event, and we are going to work within those 4 days. And I just got so much I want to talk about with you that, why even wait any longer? So again, welcome everybody. I'm glad to see everyone here and so many people in this room. This is fantastic. Let's see, before we get down the road here, let me just mention a couple of things to you as more people are piling into the room. First, sessions being recorded. Every one of these sessions are being recorded. We will get the recording out to you later this afternoon. Obviously, I'm telling all of you that are in the room right now later this afternoon. But obviously, those of you that are getting the recording, we are doing these live each day at 2 p.m. Eastern time. Also, I want to mention that that if you have questions, you can put them right there live in the Q&A box. All right. We will try to answer as many as we can, but boy, we got a lot of people in here. So we're going to stick to the most popular questions. Also, if you're catching this on a recording and you actually happen to have a question, you can always hit us up at support@tomgentile.com. All right, so that's something I want to mention too. And then finally, the disclaimer you see on the screen here. Obviously, you can read this word by word if you want to. You can do that with the recording. Just hit pause. I want to mention 2 things, and we're getting started. Number 1, stock and options trading has large potential rewards, but also large potential risk. All right. Number 2, myself, Jay Harris, who's with me today, and anyone else that I have on these Trading Essentials webinars, we are here as educators to show you what it is that we do in the market. We're not money managers. We're not investment advisors. We do not issue or offer specific trading advice. And everything I'm going to talk about is in US dollars unless noted otherwise. So that's it. What do we have on tap? I'll tell you that in just a moment. I want to welcome back all of our Optionetics students. Guys, I have partners in here who have been with me for years now, doing not only essentials classes, but our top level classes as well. I have our Tom's Option Tools members in here as well too. And this week I brought everybody in because we're at a very interesting, perplexing spot in the markets right now. All right. And I'll get into that a little bit more here in a moment. But, we do education on a regular basis with everybody, and we're doing it right now. This Monday through Thursday is that. You can find articles, you can find content in our education at tomgentile.com and optionetics.com. Also, I'll be putting up these webinars on our YouTube channel, and that is youtube.com/Tom's Trading Room. And if you go there, you can hit the subscribe button. I've got lots of great content there, and most of the stuff I do is about 10 minutes. So, that's what I've been kind of leaning into, is these 10-minute how-to videos. In fact, I'm actually going to be doing one later this week on the fast food wars. Okay, and that means McDonald's versus Burger King. And I'll talk about that. I'm gonna, and I'm gonna get into McDonald's versus Burger King. We'll talk a little bit about each one and how to play them going forward. All right. So that's something I want to mention was the YouTube channel. Finally, our software that we will be using, that we always use, tomsoptiontools.com. Subscriptions start at $79 a month. If you go there, you can find out more. So the agenda I have going on for the week looks like this. All right, like I said, lots of stuff we want to talk about, but today I'm going to cover COVID-19 strategy. We're going to talk about stock selection. All right, calls and puts and case studies, yes, case studies, no. All right, what is that? Well, hang around a little while, you'll find out. Tomorrow, we're going to do a review. We're going to talk about spread trading. We're going to get into darknet and money calendar strategies. Wednesday, I want to do a review, and I want to talk about trading cryptocurrencies. Thursday. So I'm going to do something on Thursday called the 330-300 challenge, okay? That's going to involve live trades. 330-300 challenge. So that's a buildup for Monday, Tuesday, and Wednesday. The other thing I'm going to do for you on Thursday, and this is for all of you that are live with me. So I'm giving all of you who are not here the chance to be here on Thursday, all right? But live, I've got a gift for all of my Optionetics students. You have to be here live in order to get it. And I'll talk more about that as we get through the week. So today is, we're going to talk about COVID-19. We're going to talk about stock selection. I want to talk about stock selection and go in and out of our tools for reasons to be revealed later. Okay, calls and puts, just a quick overview. All right, because I want to get to case studies yes and case studies no for a good bit of the back half of today. So that's my plan. All right, let's start with our COVID-19, what I like to call the three-step process. And we were talking about this the last time we were all together as such a big group. You may remember it. If you don't, you're going to re-remember it right now, because what we've been discussing with COVID-19 is, a three-step process as a trader, okay? Stock trader, option trader, whatever type of trader you are, you got to be taking less risk in your current strategies right now. That's definitely step number one, all right? Now, options give you the ability to do just that. The other thing that we want to do is we want to make sure that we're looking at what's going up in a down market. And that's more than just the VIX. That's more than just the US dollar. That's more than GLD, all right? But it's also things that go up in a down market include bearish opportunities. And then finally, we want to look at exploiting volatility. Now, volatility isn't as high now as it was, say, 2, 3, 4 weeks ago, all right? But it's still high. I mean, you take out the ultra high ball we had, and we're still extremely high in market volatility. So that's our three-step process that we're doing. If you took half the risk, if the market's moving twice as much, you only need half the risk to get the same type of returns that you were getting when we weren't getting these big moves. All right. So let's start out talking about, what I want to do? I actually want to move over into the overall market. And to do that, I'm going to jump into our option trader part of Tom's Option Tools, because I want to talk about, again, I want to talk about stocks, bonds, currencies, commodities, and then we're going to get into list building. So let's do that first. Let me slide over here. I'm going to log in right now, and I'm logging in, and I've got areas. In fact, we're going to go into all four of these areas, all right? We're going to get into option trader today. Tomorrow, we're going to get into contrarian trader, and we might even get into complete trader. But then I want to also move into cryptocurrencies. And then finally, we're going to move over into a portion of our partners and masters piece to round out the week when I do the 330 challenge, because that's going to be a lot of fun. All right, so let's go up to stocks, and let's go to charts, and let's go to stock charts. I'm also going to be showing you a couple of different stock charts throughout the next few days. So today we're going to focus on a 60-day chart. This is a candlestick chart that also happens to have implied volatility on top of it. Now, I don't want to use Bed Bath & Beyond. That's just the first thing that comes up in my group. But what I want to look at is I want to start with the S&P 500 or SPY. So we're looking at S&P 500 SPY, and you can see here, this was the overall highs. When we last talked, we were starting to get in the middle of this. For those of you that are joining, that haven't been with me since the last time we did this this kind of trade with Tom session. Since then, it's a whole new ball game. It really was a whole new ball game down here. But it's very interesting that I find that you know, you look at the S&P right now, and I know this has got to be on your mind. Some of you guys have got to be thinking to yourselves, what is, you know, what's going on that pushes the stock market so high right now? What's pushing this market so high? Well, it's a three-letter word. It starts with F. No, it's not that word. That's a four-letter word. It's a three-letter word, starts with F, ends with D, and the middle initial is E. It's the Fed. The Fed right now is pushing, that's right, Alicia, it's the Fed. The Fed is pushing the markets higher. It's like we're on this drug-induced high that the Fed is pushing. So, you know, when you look outside, sometimes I just wonder what people are actually thinking. Because if you look outside of the stock market and you go from Wall Street to Main Street, I mean, all the jobs that have been created since 2009, gone. Okay, look at the only thing that's been created has been more U.S. dollars and more debt, and we're going to be at a $10 trillion debt and higher so fast here that you got to think about what actually goes up when we start printing more U.S. dollars, and we'll get into that. Okay. So that's something to think about. All right. I mean, we're almost at we're rolling quickly past 7, heading to 10 trillion. And as we do that, it just cuts the dollar down, its purchasing power. So you got to think about what goes up when a dollar goes down. But eventually, it is not going to be stocks, because right now arbitrarily stocks are going up when the dollar's down. But guess what's going to be the sobering effect is going to be earnings. And earnings have come out, and we've been looking at these companies that are reporting earnings, and the majority of them have fallen off the day after earnings. So it's been a short-term effect right now. These next 2 weeks are what I like to call the sweet spot. This is the sweet spot in earnings. You know what I'm talking about. Apple, Amazon, Facebook, Google, Tesla. That's this week. All right. And then we roll into next week too. Now, the worst part of earnings is going to be probably the second week in May when all the retailers start reporting, and we all know what they're going to come up with. But get an idea here. All this drug-induced, cash-induced Fed has pushed, is this market has pushed up to highs that I'm going to give you a long-term chart for a moment. Let's go back 300 days. All right, 300 days is what? That's a year and a half. Look where we are, guys. I don't even have to go back 300 days. I don't have to go back 300 days. I can go back 150 days. 150. All right. The reason I want to take you back 150 days is because here's where we were last at this high. This was back in 2019, excuse me. This was in October of 2019 when the S&P was in the 280s, which is where we are right now. All right. We were in a totally different situation back then. Job growth was happening. Growth was happening everywhere. Now, most of this was all credit induced. All right. Most of this was all service oriented, but we were still getting growth. And of course, all of that dropped within a month's time frame. And we've had about 6 weeks to pull this back. But, you know, are we really in the situation that we were in to support stock market levels at 290? No, this is all cash. So I want you to realize that because dumb money is starting to buy into this market when they see headlines that the bottom is in, and you know, if dumb money's buying, who's selling? I think smart money is selling. These little highs we're seeing are getting to be smaller and smaller. The good news is out. How much more good news could we get? Well, obviously, good news is going to translate into higher stock prices, but I think a lot of that's been baked in right now. So what I do is I look at S&P and I look at where we are. We're at a critical sell zone right now, and I think the sell zone is right in the 290 area, because if you look here, that was where the support back in March becomes resistance today. We've already hit it once. We're hitting it again. The second thing I want to mention is that when you look at this, if we were to look at Fibonacci, a Fibonacci retracement, we're in the 50 to 61.8% Fibonacci retracement too, which is a very high area of resistance. And then third, what do the other ETFs have to say? So TLT. So take a look at TLT. Now I'm going to move us back to a 60-day chart so it's easier to see this. All right, but here's TLT on a 60-day. Now let's take out the fire sale that happened in the first couple weeks of March. And if we take that out and we just kind of take a line straight through, you can see that bonds continue to climb. And last week we were very close. We were at the open of where we were when this whole thing, or the close of where we were when this whole thing started. But higher lows, higher highs tell me that traders are slowly buying into the bond market. All right, when traders buy into bonds, what's happening? They're selling out of something. They're selling out of equities. Okay, let's continue. So I'm just moving into. In fact, I'm going to move my stock. If I move to my stock list, and I'm going to show you guys how to build something like this in and out of our tools. All right, so S&P, TLT. Here's UUP. This is the dollar index. Dollar index is stable right now. We've gone from 25.5, 26.5 range to 26.5, 27.5 range, and we're holding. And although the dollar is pulling back a bit, it's gained some momentum today. All right. Next, USO. This is the ugliest thing going right now. When you look at, if you look at commodities, this is the ugliest commodity that's happening right now. And I can't, I sometimes I look at this and I can't believe with my own eyes what's happening, that this thing is still getting cheaper. Now, we can go back. I'm going to spend 60 seconds on this. All right. End of February, we're trading at 11. The big drop, the first big drop happened at the beginning of March when the Saudis and the Russians decided they were not going to adhere to OPEC's tightening rules, and they just decided they were just going to pump at will. And when they did that, we got that big drop down from about 9 to in the 6s. That didn't hold for very long as we came down to a low of 4 at the end of March. Had a rally back to 6, and then this big move that took us down into the 2s happened when oil actually went negative last week. So if oil went negative last week, and that's all off the boards, and yesterday you hear that the Saudis are now in tightening mode. Why is USO down today another 15%? All right, why are we down 15% today when the Saudis came out and said it's time to tighten? I'll tell you why. This is what I believe. So I was logging on to my Schwab account. All right, no endorsement there, just telling you what I was doing. I'm logging on to my Schwab account, and I get a big yellow bulletin at the top of my account that says, effective today, only closing positions can happen in crude oil June and July contracts. So crude oil goes up for delivery every month, for those of you that didn't know. All right, and big companies will buy oil. All right, companies like Chevron, Exxon, the big refiners will buy oil at certain prices so they can lock in those fixed prices so they know what their costs are. All right, but as costs have come down and as supply of oil has gotten extremely high, people are trying to find places to put this stuff. But that's not the problem. What the big problem is this week is that when the exchange decided that all they were going to allow was closing in the June and July contracts, if you're long a June contract or a July contract, and most of you aren't, okay, because you don't play in this area, but if you're long and all you can do is sell and there is nobody that's going to take the other side of your trade, what's going to happen to that contract? It's going to drop. It's going to drop hard, and that's what's happening. If you take a look at these contracts, you'll see they'll drop hard. Let me show you what I'm talking about, okay? All right, so this is a futures contract here, -CL. I'm using Thinkorswim now. Again, no endorsement, but if you take a look here, this one's down 23% right now, okay? This is what it was doing since last night. Drop, drop, drop. 5-minute chart. You can see it kind of dropping in. Now it jumped since this, I mean, the low was 11.88. It's at 12.87 a barrel right now. It went as high as 14 and dropped back down, but it's down 23%. So when you look at USO, and USO is trudging. Now, why is USO down here near the bottom when June crude oil was at the bottom and spiked up to the top of its 1-hour range? Again, it's because your USO is ran by managers. Every exchange traded fund is. They have a fund manager or a team of fund managers. What these guys did was they rotated last week out of, they got into June contracts because they had to get out of May because May was negative $40 a barrel. So they get into June, then they realize, wait a minute, June might do the same thing. So they rotate out of June and get into July and August. But the exchange did something very interesting. They said, you know what, we're not going to let you add the July contracts either. We're not going to let you take new positions. So if you go to CLN 20, this is the July contracts, well, they're down 15%. So all of these future deliveries for oil are dropping. That's why USO is dropping. So is it a good time to buy USO? Because that's the question I'm seeing that's popping up on the screen. My answer is no. I am still bearish on that, on USO. That means I'm short-term bearish. Maybe I'm longer-term bullish, but not right now. All right. So that brings me to the next one, which is GLD. Okay, GLD, I believe, is a good long-term asset to get into. All right, gold. I own gold. I own gold coins. I have a number of different positions in gold, and yes, I am acquiring GLD almost on a weekly basis in my longer-term portfolio. All right, so we can do that through options. We'll talk about that here a little bit later on. All right, so that's GLD. Let's pull into, how about we look at a couple stocks? All right, I'm going to look at the popular stocks with you right now so that we can get an idea of what's happening with the ones that are reporting earnings this week. How about that? All right, now I want you to keep an eye on some stuff. What I haven't mentioned in the last couple slides, and if I back up to USO, look what USO did. When it dropped down, when oil went negative $40 a barrel last week, look at this red line. This was implied volatility. Options spiked. I mean, they were, in February, they were trading around 30. April, they went to 320. That comes roaring right back down a day later. Once the May contract came off the board, everybody breathed a sigh of relief. But look what's happening now. They're starting to spike back up again. I mean, we're talking about Friday's vol was around 130, and today's vol is up to 170. So guess what? This craziness in oil is going to continue. Now, I'll mention one more thing on oil, and that is there is a reverse split that's coming up on USO. You know what I think is going to happen? It's like a, when I was a kid and I learned how to swim, you know what my instructor did? They threw me in the deep end and said, paddle. And I would be just dog paddling, and I'd be gasping for air, and then I'd go underneath again, and I'd hold on, and I'd paddle back up and do it again. That's what I think is going to happen with USO. I think USO is going to be the equivalent of getting back above its head above water, only to go drop back down again. So what's going to happen is you're going to see an 8-to-1 reverse split. So that means USO is going to be somewhere between, let's call it 15 and 20. All right, here in the next day or two. And then what's going to happen is it's going to look more exciting for traders, but folks like me are going to be shorting that and going bearish on it because I don't think this is anywhere done yet. All right, so that's enough on USO. All right, so let's go look at, let's start with Facebook. So here's Facebook. Facebook's high in February, 220. Facebook's low in March, 140. Facebook has retraced back. And I mean, today we poked our head above 190. It's at 187.76. Now, Facebook, and I've got a whole bunch of sheets here. Facebook actually reports its earnings on Wednesday of this week. All right, so that one is coming up on earnings. Is it going to move? Yeah, I think it's likely to move. All right, but I want you to pay attention to something. Here's where Facebook's options were trading at before COVID-19 got exciting in the market. They were trading just north of 20. They went as high as 100. Where are they right now? They're above 60. All right, so they're closer to 100 than they are to 20. All right, just barely, but still very expensive. Keep that on your mind for a moment. Look at Apple. Apple's high, 320 and change, 325. Apple's low came all the way down to around almost 210. Where's Apple right now? 282.09. All right. If you didn't know any better, you'd think this was SPY. Because SPY was also trading in the low threes, went down into the low twos, and is currently at around above the 280 level. This thing's trading a lot like SPY, almost down to the dollar. Take a look at its volatility. All right. Option traders back in February had it pegged at 20% movement above and below the price range. That went up to over 100%. Now this is a little bit hard to understand without understanding what implied volatility percentages actually mean. But how about this for you? Options back in the middle of March. Is it true that they were trading at 5 times the time value as they were in February? Yeah, that's a good rough estimate. They've come back down, but they're still trading at a 45 vol heading into earnings. Apple's earnings come out on Thursday at the close. Next, Amazon. Look at Amazon. All-time highs. It opened at an all-time high again today, although the intraday high all-time was last week. But you can see it's pulling back. It's pulling back off those highs. 23.64 was trading in the 2400 and change area. Okay, not too long ago. Look at its low and implied volatility. Down here near 20, between 20 and 25. Look at its high, above 80. Look where it is right now. 50, let's call it 57. It's more to the high side as we're going into earnings. Next, Google. All right. Highs above 1,500 back in February. Lows pulled back near 1,000. This thing pulled back almost 1/3. Now look what it's done since then. It's gone up. It got very close to 1,300 today. In fact, it was 1294.10 was the high. Currently trading around 1272. Look at the implied vol. All right, the low side below 20, the high side above 90, and right now we're trading closer to 50. So again, expensive. Google reports tomorrow at the close, and then finally Tesla. So Tesla's had all kinds of spikes happening to it. It spiked up at the beginning of the year and managed to run from about $550 a share to almost $1,000 a share within a little more than a week. That spiked up the vol. It ran back up and did a retest in February, right? Then COVID-19 captured headlines, and we went from about $950 a share down to $350 a share. So it gave back a lot. But look what it's done since then. It's taken off. In fact, it's near the high side right now. And you can see here that volatility, which was down here around 50, that's actually not bad for Tesla, went up to 170. But look where it is now. It's just south of 120 as we approach earnings, which will be reported on Wednesday at the close. Okay, I brought those up to you all because I want to talk about them when we get into calls and puts. Okay, so let's now have a discussion. In fact, Jay, before I have a discussion on any of this, I'm almost afraid to even ask. But do you see any popular questions or comments coming in that you feel like I need to address before we get into stock lists?
No, the most popular question coming in is this being recorded? And I've been answering that question as they've been coming in. So you're clear to go.
Great. Let's rock and roll then. So everything I did here, I actually have it in my list symbols. And to do that, what I did for those of you that are tools members, if you go over the website and lists, you can actually create your own list just like I did. This is my stock list, and I've just put in SPY, TLT, UUP, USO, GLD, Facebook, Apple, Amazon, Google, and Tesla, and I can move these around at will. But I also have a list that I call my pennies and weeklies list. This is 250 stocks and ETFs that fit what I believe are the most liquid that trade weekly options. So this list, we actually down here under pre-computes, we actually have these under weeklies and pennies, and we have what's called the penny and weekly list. We also have a penny plus weekly list. So let me explain what the penny pilot list is and the weekly lists so everybody's on the same page. All right. For that, I'm going to go back here. Again, when we trade options, we trade them for liquidity. We trade them for protection, and we trade them for paying for protection. But I like to look at stocks on options that are what are called penny pilot and weeklies. All right. So the penny pilot program is something that Googled, you can Google, that happened about 10 years ago. And if you go and Google the words penny pilot program, you're going to bring up a piece of what you see here. This is no longer the CBOE. This is something new. It's been updated recently, so I'm going to show you what it looks like because I'm going to go in and Google it right now. So I'm going to Google. I'm going to type in penny pilot program. And now what you're going to see is, okay, get past the two ads. And the third one, the one you need to look at is this one right here. The MEAX, Options Penny Pilot MEAX. Okay, click on that, and what's going to happen is you're going to come to MEAX, the Options Penny Pilot list, and all you got to do is come right down here on this page, click on this Emerald Penny Pilot class list, and you can download that list right to your computer. And if you click on it, and I'm opening it right now, there it is. There's my imported list, and it shows every stock that is a penny pilot stock. And I can take this and I can use that at will. Now, we can do that with weekly options too. But what we do at with Tom's Option Tools is we actually go in and we can actually put these together and say, give me the pennies that also trade weeklies. That's how I drop this down to that 250 stocks that I look at. But all of this can be found by just simply Googling the penny pilot program and getting that information from MEAX. All right. So again, why do we trade options? For control, to control a block of stock for a much less price, for protection, and also to pay for protection. We're going to talk about these a little more tomorrow as well when we get into spreads. But really what I want to talk about now is just calls and puts. Now, again, a very, very brief overview, guys. Calls give us the right to buy, puts give us the right to sell. Buying calls is bullish, buying puts is bearish, all right? With calls and puts, like any option, we have different things we need to think about. First is the contract size, all right? The contract size 99% of the time is going to be one contract is good for 100 shares of stock. There are a few countries out there that have 1 equals 1,000. Right, but I won't talk about those. The next thing we want to talk about is the strike price. This is the price agreed upon between the buyer and the seller. This is the price where you as a buyer have the right, but not the obligation, to buy the stock at, okay? Or sell the stock if you're buying a put. But let's just talk about calls for now. Expiration dates, there are several to choose from. There are Monday, Wednesday, Fridays now, all right, on certain securities. There are third Fridays of the month. There are weeklies, which expire each Friday. There are EOMs. Those are end of months. There are quarterlies. There are leaps. Which are best? It depends on your time frame. If you are an option investor, and an option investor is someone who buys options with the idea to hang on to them for a long time, then you're looking at something like quarterlies. You're looking at leaps. You're looking at options that expire 90 days or greater to expiration. All right. If you're looking to flip options very quickly, then maybe you're looking at weeklies, or maybe you're looking at the Monday, Wednesday, Friday options. Typically, the ones that most people gravitate to, and I still do too, the options expire the third Friday of the month. They are the most liquid. They have more people trading in and out of them than anything else right now. All right, so that's important to know. Couple of definitions. We'll run through them real quick. In the money, option has mostly real value. Out of the money, option has no real value. At the money is where most of the volume is, by the way. But that doesn't mean that's where you want to be. At the money is where the stock and strike prices are the same, but still has no real value. Now, moving on, volatility. Okay, volatility is pretty much the last thing I want to just touch on real quick. Volatility is the speed of the stock relative to its time. There are two types we use in predicting stock movement. Statistical volatility shows us what the stock's done in its past. All right, anybody can get that. If you have a broker that has charting on it, they probably have statistical vol. If you have Bollinger Bands, that's statistical vol. Okay. Implied volatility is based on present option pricing to give you a gauge of what option traders believe the stock is likely to do, where it's likely to range to. And then finally, before I get into some case studies, puts. Okay, I mentioned this, but I'll mention again. Puts have the same characteristics as long calls, but in down markets. The same contract size, same number of strike prices. The only difference, other than everything you see there, is puts actually increase in value as stock prices decrease. All right, so let's talk about best practices, kind of that sometimes yes, sometimes no. So what I want to do now is I'm going to pull up a couple of areas that I like. And there's very few areas that I like buying puts and calls in right now. So we're gonna. The reason I called this sometimes yes, sometimes no is that I got an Italian mother-in-law that's an off-the-boat Italian mother. She starts off in English and she ends in Italian. So I understand about half of what she says. But you know, we ask her questions all the time, and if I ask her a yes/no question, then sometimes she'll go sometimes yes, sometimes no. That's what she says. She's Nona. Sometimes yes, sometimes no. So I thought it would be good to put her phrase to good use here as we discuss now option strategies. So I'm going to be looking at just buying calls if I'm bullish, buying puts if I'm bearish. All right. Let's start with the sometimes yes. How about that? So so sometimes yes works right now in a lot of ETFs. All right. So I'm going to take you to, let's look at the bond market. Let's look at TLT. All right. So TLT. So I'm actually going to go to options chains, and I'm actually going to go to, let's go to TLT. So TLT is the bond ETF. Now, why in the world would you want to buy a call option on bonds? Because if you believe the stock market is likely to head lower, then traders will move in out of equities and into bonds, and that should make something like TLT move higher. Now, perhaps May 15th might make a good date to look at this. Why May 15th? There are so many different expiration dates out there. What makes May 15th so special? Well, because it's the third Friday. May 1st is the first Friday. May 8th is the second. May 15th is the third. If you look in June, you've got now we've got 5s and 19s. There's a 12 in there. It's missing because they haven't come on the board yet. But June 19th is also a third Friday. That might be an interesting one as well. Why don't we look at both? We're going to look at TLT, and we're going to look at 10% above and below the current price of the asset to look at strikes. And I'm going to look at all Greeks. Now, when I do this, I get a list of calls on the left and puts on the right. Since we're just going to deal with calls, let's blow this side up, shall we? All right. So now I'm looking at just the call option prices. These are in the money. And the reason they're in the money is you can see how much they're going for. A 152 call for 16 points? No, thank you. All right, come on down, and you can see here the 160, the 165s. All right, they're $4.80. So let's talk about what we're looking at here. right? Because again, if you're a novice option trader, all you worry about is price. And they wonder why 80% of option traders fail. I'll tell you why. It's because all they think about is price. That's like someone that's going to forget about getting their pilot's license. They're just going to take off. And they pull this, they turn everything on, they start the props, they run down the runway, they pull the stick back, and then they're in the air, but now they don't know how to land. And they're going to land hard. So an option trader that just looks at price is just like an amateur in any other profession. If you want to build a house, it's best if you learn how to build a house and become a general contractor. If you want to be an electrician, that's something you want some knowledge, instruction, and experience in before you go messing with electricity. And the same goes for being an option trader. However, there's no barrier to being an option trader like there is to being a plumber, an electrician, or a general contractor. But you know, here you could lose your financial life if you don't know what you're doing. So 480 is just the price, all right? But how much is this 480 likely to move with a 1 point move in the actual underlying asset? Well, that's what this number's for, all right? The 68.62 number, yeah, you know what? That's kind of interesting to know. Well, that's because that number is the delta of the option. It's what the option is like, that particular option is likely to move. 68 cents if we get a 1 point move in TLT, all right? If I come down here and I look at the 168s, they're likely to move a little more than half as much. So this $3.10, again, if I get a 1 point move in TLT, if we go from 168.41 to 169.41, this should move from 310 add about 52 cents, maybe a little bit more, 55 cents onto this, and you'll be at 365, theoretically. All right, so that's probably the first lesson you should know in options is they don't move like stocks. But most, if not all of you know this already, right? But some other things we might want to know too, and that is, if you come up here to the grid, you can see the implied volatility. That's important to know, right? Here's gamma theta vega when you look at Greeks, but that IV number, and when you look at the IV that's in blue, that's the cheapest of all these options, are the 165 half calls right now, right? These aren't so bad though. When you look at the 1974 or 1979, they're cheap compared to other options in the same category, the same expiration date. All right, but when I say sometimes yes, what I mean is that if we look at TLT once again, let's go back to our stock charts and let's look at TLT. Here's TLT. Do you see this? Do you see that? That red area right there, it's down here near the bottom, it's near 20. That's a decent implied volatility number. Even though it's been cheaper back in May, it's also been a lot more expensive. This has gone from a 65 down to a 20. All right, so this is a sometimes yes for trading calls. Come back to the options. And for instance, and again, I haven't looked at this and said to myself, I'm buying these calls. There's got to be more to it than that. Okay, so this is not a recommendation. All right, I'm just looking at it and saying, if you're bullish, then perhaps the at-the-money calls make sense to you. If you're bearish, perhaps the at-the-money puts make sense to you. I'm telling you, this is a case where buying calls if you're bullish and buying puts if you're bearish makes sense. All right. Okay, let's look at another one. I want to come up here and I want to look at UUP. UUP is the double dollar index. This one also has options that expire on May 15th. It also has options that expire on June 19th, those third Friday options. What we'll do, we'll look at a comparison between the two of these because they're not going to have as many strikes as that last group did. So here's UUP. Now, the May 27 calls are trading for 26 cents. Those are actually in the money, all right, by 12 cents, but at least you know that almost half of this price here with 3 weeks to go is already is built into the actual strike price itself. Okay, so this one here, if we get a move that is to the top end of that range, to the most recent range, which is like about 27.5, then a 27 call at 27.5 is going to be worth 50 cents. If you paid 26 cents for it, and it goes, this thing goes to 27.50, you have almost doubled your money on this particular call option, right? Do you know what else UUP is good for? UUP is also good for a person who expects the stock market to go down, but wants to have lower risk rather than going out and shorting stocks or shorting the S&P. Okay, so this is an example of one too. Look at this too, 8.45. You know what that represents? Implied volatility. So again, if I were to look at UUP on the chart, take a look at that stock. Look at the implied volatility. The lowest it's been is down here around 5. The highest it's been is up here around 75. Okay, where is it at now? Down below 10. This is a sometimes yes. Okay, now stocks, bonds, currencies, commodities. Let's look at one more. Let's look at GLD. Is GLD a sometimes yes? I think not. Okay, I looked at GLD, and if I look at GLD's options, and I'll show you why. Take a look, we'll go up here, I'm going to type in GLD, and now I need to plug in the May 15th options and the June 19th. And did I say I was going to compare one to the other, and I didn't do it with a UUP? We'll do it with GLD right now. Let's look at 3%. That'll tighten this up a bit. 160.94 is the price of GLD right now. Look at all these people bunching into these trades. That's a high open interest. Okay. The 160 calls, 385. All right. Again, not the worst, but not the best either. I mean, this is going to have to go up in 3 weeks, and it's going to have to go up by, by a few dollars at least just to get you to break even. It's going to need to go up a good 5% to get you a double, a little less than 5% in a couple weeks. So this is for the May. Well, why don't we go out and look at June? Let's scroll down and look at June. Here's June. June's options expire 53 days from today. So if I look at the 160 calls in June, well, they cost double. Double the time must be double the cost. Actually, it's a little more than double the time. You get an extra week or so out there, but it still is almost double the cost. So you need double the move. You need, in this case, about a 4% move to break even. You need about an 8% move in gold to double. All right. Can it happen? Absolutely, it can happen. But these have been better priced than they are right now. So it's kind of a sometimes yes, sometimes no. Let's look at some sometimes no's. All right, so some sometimes no's look like this. I'm going to go back to my list, and I'm going to go ahead and update, and we're going to see SPY. SPY is getting better. This is like a sometimes yes, but the timing's got to be critical on this one. Okay, we looked at the others, but let's start looking at some stocks. Let's look at Facebook. All right, Facebook's got earnings coming out in a couple of days. They're coming out this week. Wow, I think Facebook's going to move. I'm being sarcastic when I say that, guys. Okay, I think Facebook's going to go up. I think Facebook's going to go down. All right, is it a good time to trade both sides of it? Well, you could. Let's take a look at an option trade of Facebook. So Facebook's options right now, and I could look at them. Okay, so you know what? Those earnings are coming out soon. Let's just look at the options that expire on Friday, because that's where the exciting part of Facebook's going to be, right? Okay, let's take a look at Friday's options, and let's look at the monies, the ones that are right here. Here you go. Don't have a lot to choose from. Stocks trading at 187.76. So the 187.50s are the monies. All right, so if I bought the call options, then where does Facebook need to go to break even? Let's take a look and see. We got to get to 194.33 by Friday to be at break even. We're at 187. All right, that's a good bit higher. What if we thought Facebook was going to drop after earnings? There's a lot of us in the room that are bearish on these. Well, the 187 puts, they're not any better. Okay, they're trading at 655. So if I erase the call and I bought the put, 187, and I'll put a 1 in there. Now let's go up here and hit that risk graph, and you can see here you've got a trade that has $180.95 to the downside. And here's the problem, guys. Take a look at this. See that 180.95? See this right here? These are standard deviations. By Friday, this thing actually has to get below. All right, has to get below where we were yesterday. And yeah, you know what? There's a 5% chance it could get down here to this area we see on the graph. All right, which is around the 178-ish area. All right, what does 178 do for you? Gives you $2. All right, gives you $3. Gives you $3 off the break even. So you're gonna pay $6.50 for something that you could maybe make 40% on if it drops outside of the channels and drops to the bottom end of this channel here. Okay, like I said, it could happen, but probabilities, there's your probabilities. Ugh. I mean, we could do better than that. All right, so this is what I call a sometimes no. Sometimes no, because you're buying expensive options, right? And the poor soul decides to go in and go both ways, because you know they're out there. And they're going to say, you know what, I'm buying the call and I'm buying the put because I don't care where market direction is. I'm going to be right regardless. Well, that person is going to be paying $1,338 for one straddle. And that means their break even is 174 to the downside or 200 to the upside. All right. Last time Facebook saw 200 was before a lot of the COVID hit them. The last time it saw 174, well, it was at 174 last week. So it could get back down there again. But again, what do you got to do to make, you're looking at break even. We don't trade to break even. We trade to make money. So you got to look at this break even move, this over $13 move upside and downside, and add another 13 on it if you want to double in value. All right, so that's Facebook. Okay, let's move through these a little bit quicker. All right, so I want to look at here's another sometimes no. Let me bring up the other sometimes no. I'm gonna move this over. All right, and so let's look at Apple. Okay, so Apple, well, guess what? Apple's more toward the low end of volatility since the beginning of the year than high, but what kind of price points are we talking about? So Apple results come out Thursday, so we could look at the Friday options here too. So in this case, I'm going to take my stock option table and I'm going to change it from Facebook to Apple, AAPL. And May 1st looks fine. Let's take a look at what's going on in May. Your at the money calls, 282.76. So the 282 halves, $7.08. You're gonna pay $700 for that call option that expires in 4 days. If you're bearish, you're gonna pay almost the same price, $683 for the 282 puts that expire in a couple of days. Now, there's a chance these things could get up and run, but the probabilities just don't say it. All right, because again, we're talking about something that, in this case, I think Apple so far is the best of the bunch. This Apple is the best of the bunch. What about, does it get any better or worse? Well, let's look and see. How about Amazon? Boy, that one's going to be expensive. Do I even need to go into this one, guys? I mean, look at how much these are going to cost. This is insane. AMZN. Okay. Calls on Amazon. All right, if it were 2369, we're probably looking at the 2370s, 77 points. Okay, and if you're bearish, 77 points. So, and if and a straddle is going to cost you 100 and what, 154? That's a lot of money. 154 points. That's 15,000. Is that $15,000 for a straddle? You betcha. All right, with probabilities of being very, very low. All right. I've seen a lot of people out there saying sell them, sell premium, and you can sell premium. And we're going to talk about creating spreads on these tomorrow. We're actually going to take these and we'll look at them again tomorrow because none of these have earnings coming out till after tomorrow. So we got plenty of time to build on this subject. All right. So that's Amazon. Let's take a look at the next one, and that would be Google. So Google again. Look at the red line. The red line is what option traders look at. All right. It's 15 and 95 and 50. So it's still kind of expensive. So when I look at the options on Google, I'm going to get the same setup. Very expensive compared to what they used to be. You're talking about the at the monies, 1270s, 34 bucks. All right. 1270 puts, 34.15. Expensive. Those could be spread. We'll save that spread for another time. And let's move into, I think it's our final chart, Tesla. Now, Tesla has had IVs that are on the low side at 60 and the high side about 170 and change, and where we are right now, close to 120. So you can only imagine what these options are going to be going for. TSLA. And again, I'm just looking at the May 1st options, because we know they're only going to get more expensive from here, right? Where are we? 791. So the 790 is what we're looking at. $51.05 for the 790 call. $49.95 for the 790 put. Right? Could this stock go up or down 100 bucks after earnings? Yeah, it could. It could. But why risk? Why put that much risk on the table when we can do so much better for so much less? All right. So that's what I wanted to do with you guys. I talked about COVID-19. We talked about stocks, bonds, currencies, commodities. We talked about putting stock lists in and creating these stock lists with you. Also, I talked about that, you know, what we called sometimes yes and sometimes no, and that I am not buying options on Apple, Amazon, Facebook, Google, or Tesla into earnings. I would rather spread that risk. I'm going to show you how we spread that risk tomorrow. And Jay, at this point, anything that I may have missed out on as we finish up our session for today?
Craig was asking how you create the stock list. I think you went over it. Did you not?
I did. I mean, you know, and you know what I want to do also? I'm going to give you guys an idea of what we're going to be covering tomorrow and how it relates to the S&P. All right. So I'm going to leave you on that note. But before I do, let's go back and let me show you that stock list again. So if you go to website and you go to lists, all right. So website, lists, edit list, and it's going to bring you into, and you can select whatever list you want. But if you select your stock list, you just type them in. I just type them in. You put a comma, a space, or you can hit enter on each one of them. Then once you click save, it'll throw the names down here at the bottom to let you know you got the symbols correct. And there you go. You're off and running. All right. So let me leave you with this. All right. To my partners and all of our software users, where we have been going through these now for the last couple weeks, it's no secret that I am short the overall market, SPY. Right? I am looking at a return to prior lows. In fact, I think the market could go even lower than that. All right. So I'm going to tease you, because we're going to talk about, you remember today we talked about the sometimes no's. We're going to make those the sometimes yeses tomorrow as we talk about spreading these. And this could be spread right now, you know, putting something out there later into the year. not too far down in the year, but summer into early fall, where we could put on potential trade candidates. All right, that if the market drops, we could see 300, 400, 500% rewards. I call that an insurance, basically an insurance plan. And that could be your paycheck protection plan. It could be whatever you want to call it, but it's set up and designed to where it backfills money into your account, all right, against what could be, we already see as a fallen economy. What we already see as a recession, that even the Fed says there's a 100% chance we're back in a recession again. And it just look at these numbers, these unemployment claims that are coming out. That certainly tells the story. So I'm going to leave it there, guys. Thank you very much for being part of our day one. Again, what we're going to get into in day two is quite a bit more. If I were to leave you off, everything we're going to be talking about today, tomorrow, and Thursday happens to do with spotting opportunities, creating low risk trades, planning, executing, and managing those trades. And once again, if I could just tell you, recording's going out later today. If you got questions on this webinar that you didn't get answered or that you want to ask, there's always support at tomgentile.com. And of course, the big question that we see when we do these is how do I subscribe? Our option tools start at $79 a month. You can go to tomsoptiontools.com for more information. Okay, tomorrow, big deal, because we're going to be going into channels. I'm actually going to look at charts tomorrow, but I'm going to look at them with channels. We're going to look at darknet and money calendar strategies, and we're going to go back and we're going to look at those big five again: Apple, Amazon, Facebook, Google, Tesla, and talk about how to trade spreads on each of those. All right. Thank you very much. Enjoyed it, guys. I'll see you again, same time, same channel tomorrow. Till then, take care. Bye now.